All right, welcome back. You know, it happened to Palantir the other day, and to some degree it happened to CoreWeave overnight. These companies report great earnings, beating on the top and bottom line, and then they get punished for it, right? These tech stocks are sometimes priced to perfection. I get that. Buy the rumor and sell the fact is part of the game. But algorithmic and high-frequency trading is also part of the game, and they're also part to blame. It's not a really new issue. It's an evil that the traders have had to deal with for more than probably the last 15 or maybe even 20 years. My next guest sees it as a way that the professional electronic trading community can move money from the weaker retail hands into the stronger high-frequency trading hands. Now, a lot of retail traders sitting at home right now trading in their basements probably aren't aware that they are definitely in the minority. A majority of stock trading volumes today emanate from machines. AI has been in the trading world long before the world ever heard about it. Let's bring on an expert to walk us through it all. Please welcome to the show, Keith Fitz-Gerald. Keith, thanks for coming on. I'm not saying these are your picks or not, but I am saying that's an example of seeing great results and getting punished for it. Palantir is probably the poster child for that. CoreWeave, I'm bringing on that one up because I actually own it and I'm getting slaughtered right now on it. But they had some pretty good results. So it's one of those things that we have to deal with this. These price to perfection stocks, and then they do sometimes get punished, even though all the news is pretty good.
Well, and the funny thing about it, Scott, is they're not getting punished because of you or me or anything the company did. In fact, the company's doing everything it's supposed to do. It's a very nasty part of Wall Street and something that doesn't get talked about as much as it should. What happens is that the big money has figured out that retail investors will buy because of FOMO. So what they do is they create conducive situation. They create enough volume to drag that price up into earnings because they think the investing public is going to buy on great news, and they do. But what happens when that happens is that the big money now uses that as an exit. They trap in, they break out, all the breakout orders, the resting orders, everything else get kicked into motion. Then they reverse hard, send it lower, and crash through all the trailing stops and the breakdown entries. So they get effectively a 2-for-1 shot. Now, the way around that is actually pretty easy. For a retail investor, you think like the hunter, not the hunted. If you know this is the term, wait until they've had their run, until they've gotten their yayas out, then step in with a low ball order after earnings, and you know what? You'll probably be laughing all the way to the bank.
Yeah, you know, that's the problem with retail investing, though, right? That everybody always wants to buy on the highs. They don't want to buy when the market's going lower. It's probably one of the few places that people don't like to buy things on sale, right? Macy's, if you want to buy that yellow tie that you're wearing on sale at Macy's, you do buy it, right? You're going to take 20, 30% off. But if a stock is 20 to 30% off, people run for the hills, or maybe even worse, they sell what they own on sale. I mean, that's the part, that's the psychological part that people need to get over when they're trading as far as a retail trader, right?
Well, it is, and it highlights a very important, subtle point that we talk to our clients around the world about every single day. Most investors unknowingly play not to lose, but most professional, successful investors over time play to win. So when you flip that around mentally and you start thinking about constantly maneuvering for the win, everything else falls into place and it gets easier because you no longer worry about the downside. You're playing to win, and that's a very different psychology. It will allow you to make better, more consistent investments.
It happens not only in investing, it happens in sports all the time, and that's a great way to look at it, I think, from my point of view. Pitchers doing very well. They bring in some closer to kind of preserve the win. It's almost like a prevent defense, but all that happens is they blow the win because they didn't continue down the same path as thinking like an investor and thinking aggressive, like I want to play this. All right, so prevent defense in football is another great one, right? All of a sudden, everybody drops back. They just want to, protect the big play, but then all of a sudden they start to lose the game because they haven't been playing as aggressively as they have done before. That's exactly what you're talking about when it comes to investing. There's a lot of similarities there, a lot of parallels. And if you can think like that person, like you say, the hunter instead of the hunted, it makes a big difference. So I think a lot of people don't like to be in a market where the market, they buy and it keeps going lower, or they buy and it keeps going lower. But that's also something you need to get over, correct?
Well, it is, but there's also ways to handle that, right? Everybody thinks about betting or like they think about investing or investing like they think about betting. It's not an all or nothing. So the way you control that risk, even if there's more selling ahead, is maybe you slow down your buying. I mean, you don't buy as aggressively as you otherwise would, or you use a simple tactic like dollar cost averaging. Or maybe if you're an options trader, you start selling cash secured puts way down, way deep in the chain, so that increases your probability of success. Because now you're thinking like a winner. You're not worried about what happens if you lose. You're worrying about what happens if you don't win. Because people always, Scott, like to think of what could go wrong. What they should do is think about what could go right and what are they missing if it does go right. That's how you make the transition.
Which I'm going to put a bow on this for you. That was so perfect, Keith, because nobody was thinking about what could go right when Trump was talking about, his tariffs April the 2nd, right?
Bingo.
Liberation Day. It was about what could go wrong. And everybody ran for the hills. So a lot of them voted with their political feet. But at the end of the day, nobody really thought, well, what if these tariffs actually work? Or what if all these firms or these companies come to the U.S. to want to cut a deal? And guess what? Anybody that had the thought of, what if this actually works, is sitting really pretty right now. And I think there's about $6 trillion or maybe $7 trillion on the sidelines that was thinking, what if this blows up and it doesn't work out? They're the ones that are behind the 8 ball going into the end of the year, correct?
They are, and you and I, in fact, talked explicitly about why tariffs would work, and I made several historic examples right here on your show about that. So I hope viewers paid attention, because companies like Palantir are going to continue to do well. Microsoft, Apple, CoreWeave, they're going to continue to move into the world of our future. Anybody that's trying to slice and dice the world of our past or waiting for a pullback, you know what? They could be waiting a long time.
I know there's a lot of money that's waiting. As they say, as Ricky Ricardo would say, you're going to have a lot of splaining to do, Lucy, at the end of the year this year if you're not on board. So, all right, brother. Have a great rest of the week. Love having you on, Keith. Keith Fitz-Gerald coming to us from Seattle, Washington. Great to have you on. Thanks. All right.